How do we build wealth? How do the wealthiest capitalists and business people of the world do it? What financial advice would these genius investors or titans of industry have for the common person trying to get ahead? In his 2016 letter to shareholders of Berkshire Hathaway, Warren Buffett left us a clue. Okay, he just told us outright his advice. He wrote, "Over the years, I've been asked for investment advice, and in the process of answering, I've learned a good deal about human behavior. My regular recommendation has been a low-cost S&P 500 index fund." Great. So what is an S&P 500 index fund? Well, the S&P 500 index is broadly accepted as the best gauge for measuring the aggregate performance of the U.S. stock market. There's a bit more to it, but in essence, if you own an S&P 500 index fund, you own a tiny sliver of each of the top 500 or so most valuable publicly traded businesses in the U.S. In his 2016 letter, Warren Buffett left us another clue when he talked about Jack Bogle, who created and introduced the first index fund in the 1970s. Buffett wrote, "If a statue is ever erected to honor the person who has done the most for American investors, the hands-down choice would be Jack Bogle. For decades, Jack has urged investors to invest in ultra-low-cost index funds." So how well has this S&P 500 index done for investors? That's a bigger question than it sounds, and this is where the fun begins. Let's take a look at 2017. There are a couple of really good reasons to start with a view of 2017. First of all, it was a great year for the U.S. stock market. If you had invested $1 in the S&P 500 index at the start of the year, that dollar is worth about $1.19 as of the end of 2017. Or to put it another way, the index had an annual return of about 19%. Now that's quite good and very tough to beat. But there's more. In addition to the price appreciation, investors would have received dividends along the way, perhaps as much as 1 or 2% a year. I'll talk more about dividends in future episodes, but for now I want to focus on the price appreciation. This is a broader historical look at the index from 1950 through the end of 2017. The plot is normalized such that you can see how a dollar invested at the start of 1950 performed through the decades up to now, again ignoring dividends for the time being. You can trace the index from the 50s, 60s, and 70s and see some ups and downs that look kind of small in relation to the value of the index today. But as we'll see in future episodes, there is some perspective that gets a bit skewed when the index is viewed on a long time horizon. Hint, compounding returns. In the 80s, an interesting event to note is the stock market bubble and subsequent market crash of 1987, which is sometimes called Black Monday. On October 19, 1987, the stock market declined more than 20% in one day. The market recovers into the 90s and really starts to climb. You can see the market take off around 1995, and somewhere in this time frame, we see the makings of the tech bubble. In the 2000s, the tech bubble bursts over the course of 2 to 3 years. This is followed by a short recovery before the financial crisis of 2008 and 2009. The decade of the 2000s was a tough one for investors. Now for the 2010s, you can see the upward climb of the bull market that we're currently in. If you had invested $1 in the index at the start of 1950, that original dollar would be worth about $160 as of the end of 2017. Now some years are better than others and some years are certainly worse, but as you can see, over time the index has continued an upward climb. One of the biggest things to take away from this view is the upward curvature. More to come on this in future episodes. But again, a hint is compounding. Here is another way to look at the index. These are annual returns which illustrate how the index performed in each individual year. If we focus on the decade so far of the 2010s, we see that the annual returns are not so outrageous compared to history, going all the way back to 1950. The individual years since 2010 look somewhat average, or at least there appears to be better years on record. 2013 and 2017 were great years, but not really unprecedented compared to the history. And in fact, investors in the index were down slightly in 2011 and 2015. The significant characteristic of the 2010s that catches my attention is not the dramatic up years that might be inferred from the historical plot, but rather an absence of dramatic down years or a string of down years such as the early 2000s. Take special note, 2008 was the worst year in the history of the index since 1950. Here is yet another way to put this current decade in perspective. I've normalized each of the decades, the 60s, the 80s, etc., to show you how well a dollar invested in the index did over the course of each decade. For example, if you had invested $1 at the start of the 80s, it would be worth about $3.25 at the end of 1989. You can see the 2010s in gold, which is in the running with the better decades on record, but is not unprecedented nor a monumental outlier compared to the other decades. This is an interesting way to look at some of the history in the index, but it must be stressed that where you start and end these curves for comparison can be somewhat arbitrary and will have dramatic impacts on the way the curve looks. For example, the 90s look amazing mostly because the tech bubble reached its peak in 2000. And further, the 2000s do not look good in this chart because they started on the high of the tech bubble, which was followed by the tech burst, as well as the financial crisis of 2008 and 2009. There's one more reason 2017 was an interesting year that I want to highlight. December 31st, 2017 marks the end of a 10-year bet that Warren Buffett entered into. The details of the bet are highlighted in the 2016 Berkshire Hathaway annual letter, and here yet again Warren Buffett leaves us some clues. In context of the bet, Buffett asserts, over a 10-year period commencing on January 1st, 2008 and ending on December 31st, 2017, the S&P 500 will outperform a portfolio of funds of hedge funds when performance is measured on a basis net of fees, costs, and expenses. He goes on, a number of smart people are involved in running hedge funds, but to a great extent their efforts are self-neutralizing and their IQ will not overcome the costs they impose on investors. Investors on average and over time will do better with a low-cost index fund than with a group of funds of funds. Now I highlight this bet because it's such a wonderful place to learn about so many aspects of investing effectively for the common investor. It brings to light important topics such as actively managed funds, index funds, weathering market ups and downs, the impact of fund fees, and the concept of a time horizon for investing. If you recall from the bar chart of the annual returns, 2008 was the worst year in history for the index since 1950. From January 1st, 2008 to somewhere in early 2009, the index declined on the order of 40 to 50%, and this is exactly where the bet started. Yet, over the 10-year period, Warren Buffett still bet correctly, and his assertion held up. In fact, even with the monumental decline at the start of the bet, the index almost doubled over the 10 years. It is up about 88% overall as of the end of 2017, or put another way, the index had an annual rate of return of about 6%. In the context of the bet, Warren Buffett got to count the dividends as well, which makes the returns even higher. That is an absolutely astonishing result to me. If you are just getting started with investing and are new to the game, there is no better place to start your education on investments. The index, or for that matter American business, has weathered some monumental events and continued its relentless upward climb. Through this period since 1950, we've seen the dawn of unimaginable technologies, the computer, the cell phone, the space race, hyperspeed information exchange, and so on and so on. Entire new industries have emerged while others have faded away. We've seen monumental geopolitical events as well. The fall of communism in Russia, the Cold War, the assassination of an American president, 9/11, and numerous conflicts and wars around the world. We've also seen the emergence of new major economies and continuous shifting in the balance of trade around the world. It's also amazing to look back and add in the significant financial events over this timeline. The crash of 1987, the financial crisis of 2008-2009, as well as the tech bubble. Now we are able to see them with a little time, space, and perspective. It's somewhat unthinkable to regard these as bumps in the road as they were monumental events at the time. But that's exactly what they're starting to look like now as American businesses continue to invest, innovate, tap into new markets, and improve on the old. I want to leave you with a favorite quote of mine again from Warren Buffett, which can be found in his 2012 letter to shareholders of Berkshire Hathaway. He wrote, "American business will do fine over time, and stocks will do well just as certainly since their fate is tied to business performance. Periodic setbacks will occur, yes, but investors and managers are in a game that is heavily stacked in their favor. He goes on, since the basic game is so favorable, Charlie and I believe it's a terrible mistake to try to dance in and out of it based upon the turn of the tarot cards, the prediction of experts, or the ebb and flow of business activity. The risks of being out of the game are huge compared to the risks of being in it.